Hi, and welcome to the Profit Playbook. Perhaps you're a manager and you've been approached to actually buy into the business that you work for. One of those options has been through a management buyout. This is the video for you. So between myself and my colleague, Ed Gooderham, we're going to be navigating these issues and exploring some of the more detail of what to look out for in this transaction. So let's get into it. Welcome back, Ed. So today we're going to be talking about management buyouts, but mainly from a seller's perspective. For the viewers who doesn't know what a management buyout is, we've got another link to another video of exit strategies, just talks a little bit more about that. So realistically, what we're trying to do is work out what management buyouts mean from a seller's perspective. So why would a business owner consider a management buyout in terms of an exit strategy as opposed to potentially, say, a third-party sale?
So sometimes you've got clients who want to sell their businesses for the most money possible, and therefore they go to the market and get the best price they can. Other times you've got business owners who actually really care about their staff and their customers, and they might actually have created a nice ethos in their business which they want to continue. And therefore management buyout is the best way to try to continue that ethos and keep the staff working how they always have done and how he's built his business. The other reason sometimes there isn't a market for selling your business. And therefore sometimes you look at your management team and actually they're running your business for you. Do they want to step up and own it? And therefore that's a nice way to encourage them, challenge them. And often they do stand up and take that charge and really run the business going forward.
Okay. So what are some of the challenges that a business owner would face typically from a selling perspective?
So one of the biggest challenges is most of their managers won't have the money to pay for it. Always a bit of an issue.
Yeah. Can't put the salaries up either. That's just crazy, isn't it?
So the big thing there is they can either go to one of the loan people and see if they could borrow the money, if it's a make or break, because the person selling the business wants to be out as soon as possible and they need the cash. Alternatively, most times in management buyouts, they're over a period of time with deferred payments. Okay. So sometimes they'll get a lump of money on day one and then same payment going forward for a number of years. And that works very nicely in management buyouts because you're using the business and the profits of the business to pay for the exit of the owner, which is a nice way of doing it.
So how long would you say a typical management buyout process from a sales perspective would take usually?
It's a very good question. As we said in the exit strategies video, planning your exit could take years. And with a management buyout, you've got to have a management team that's in place to actually take on running the business. And you step away and no longer involved, or to a very limited amount for a small amount of time. So it could take a couple of years to make sure that the management team is how you need it to be. Now, if you've got a management team that's already there, great. And then it can be very short, 3 to 6 months, by initial discussions with them to come into an agreement, having a share purchase agreement put in place, and an agreement on how the money is going to be paid across to them. Because that's obviously normally the biggest issue is the person selling wants the cash eventually.
Quite right. So typically speaking, then it can be as long as a piece of string. It's always reviewing your exit strategies and trying to make sure that if this is the right strategy for you, making sure you're always putting efforts in place to put a management team in place, and then effectively executing the transaction when the time is right.
And like I said, a big part of it is your ethos. There's lots of business owners who really enjoy their business. They have built something they're very proud of, and they want it to continue. And therefore, having the guys who helped you build it and run it is the easiest way to keep it going.
Yeah. So, have you had any examples of working in this sort of area with your clients in the past?
Lots.
Any success stories? Any sort of horror stories? Or
no horror stories yet, which is great.
That's great.
But yes, lots of clients I've worked with where we've made sure that we've got managers in place for them because they're talking about exits and looking at the different parts of running a business and trying to get people to step up and take ownership. And sometimes people are hesitant, so that's why it's important to have a long lead time between when you really want to exit and when that person's ready. So, because some people, it takes 2 years for them to actually have done it for a little while and feel confident that they could actually do that and be one of the owners of the business. The other big issue is trying to agree how much the business is going to be split between the different buyers. You might have a very strong character who thinks he should have a bigger share than the other characters, or you might want to split it equally. And you have to be careful with that, because you might have 4 people who are the managers and they all have 25% each. Well, you're leading then into issues if they would disagree in 2 against 2. Yeah. So you have to think about all these sides to the future of it for yourself as well.
Yeah. So how would we look at potentially financing a transaction like this? We mentioned that debt is usually quite expensive in general. So any other ways?
So like I said earlier, deferred payments is one of the biggest ways that these things happen. But often the seller wants some money up front. So normally the person selling the business has a plan to sell the business. So they might have left quite a lot of money in the business in cash, ready for an exit. So what would normally happen is on day 1 of the sale, they would take that cash out as part of the settlement. What that normally does is it inflates the price that they sell the business for. And then the rest of the money that they want would be on deferred payments. Like I said, could be over 3 years, could be over 7 years, could be over 10 years. Obviously, the shorter the period, the better, because more chance of getting paid. Yeah. The longer the period, if anything happens with the economy or other things, you more risk. Yeah. And so that's what we normally discuss with clients as the various options. But again, the earlier you can plan for it, the more you can make it as tax efficient as possible.
That's right. So you're talking about retained earnings in the business, cash at bank, etc. And those clients who tend to maybe left planning to the last minute and they're looking quite soon at the retirement sort of exit, then they'll probably be thinking, well, I don't have time to build this cash up. In that instance, potentially third-party loans, etc., to try and finance the transaction instead.
The problem with third-party loans is that it puts a level of debt in the company and then a level of fixed cost in the company that wasn't there before. Mm-hmm. So all of a sudden you put more costs in the business with interest and payments that would make cash flow and profitability less. Now, obviously, cash flow wise, you are going to have payments as deferred payments, but you haven't got the interest element normally. Mm. So normally most of the deals that I've done with clients, we don't charge interest on the deferred payments because it's looking at the whole scheme as a way to pass it on to the next generation.
So other than third-party debt or built-up retained earnings at the point of the transaction, I suppose effectively we're trying to finance this through profits every year. Is that effectively it?
Yeah, so the deferred payments will come out of the profits the business is making. And this only works if you've got a profitable business. Yeah. Like I said earlier, if they've built up a level of cash in the business, that's a sign that they are making good profits.
Yeah.
And the whole valuation of a business is based on the profitability of the business. So you'd have to have the profits there in order to value it at a higher figure than zero, if you like, to make sure that the seller is getting some money out of this.
Okay, so again, managing your profit, maximizing profit throughout your business journey to get to sort of this stage is actually going to be really important as well, at least even just to give you options.
Yeah, I mean, one of the things I do with a lot of my clients, if they want to exit the next 3 to 5 years, we'd look at taking less money out of the business and leaving more money in the business so that they build the cash up.
Yeah.
So that when they do exit, at the moment, they can take it 10% tax, up to £1 million per person. And that's far more favourable than paying high rate tax at 33.35% or 39% if they're a high rate taxpayer.
Yeah.
So it's all about the planning again in terms of even the current year's planning and looking at profits and income.
Yeah. It actually touches on the other side of this as well. Is there a tax efficient way of approaching these transactions from a seller's perspective, of course?
Yeah, so most management buyouts would be selling the shares. And like I said earlier, that crystallizes capital gains tax. At the moment, you've got business asset disposal relief. Now, we have a budget coming up. So at the time of recording this, you can pay 10% of the first £1 million of your capital gain. Now, that could change, and it's probably likely to change this year.
Yeah.
But that's the most tax efficient way of doing it. Sometimes you might have a sale of assets. So for some reason, the person selling the business, I don't know, they might have a name of a company that they really, really have a personal link to, and it's not actually the trading name of the business. So then the new people start a new company up and transfer the trade across, but that doesn't normally happen when you've got a management buyout. Because sale of assets is a different way of doing it.
Yeah.
You then pay tax on the profits in the company of selling the assets, and then you have to exit it by way of a liquidator if it's worth more than £25,000, which 99% of the time it is.
Let's hope.
And then you've got liquidators fees, which could be £3,000 to £6,000 for solvent liquidation. And that's just not the best, most tax efficient way of doing it.
Yeah.
But then I do have other clients who've done exit strategies where it wasn't big figures, you're probably talking about £100,000. They did want to keep the company. They didn't take all the money out on day one, and they took out in dividends every year.
Yeah.
So there are various options depending on how it works for the client.
Yeah.
And you have to look at what the client wants, what their goals are, in order to decide that.
Yeah. It's interesting. It's just so many versatile ways, isn't it? Depending on the type of business, the personality, and the attributions of the client as well, the seller in this instance. Obviously making sure you've got a management team in place to even see if this is a consideration. So there's a lot to think about. What are some of the key takeaways that you would advise a seller then? A
key takeaway if somebody who's looking at selling their business as a management buyout, first thing is, have you got a business that's profitable enough so they can make the money in order to pay you for the business? Have you got a management team that is good enough to run the business? If you've got both of those, and then are the management team up for doing this? Like I said earlier, this can scare people off.
Yeah.
Because they just are good technicians, they're not business owners.
Yeah.
Some people, they thrive, which is what you want. And then the last issue is looking at how much money you want from day one and how much you're willing to defer. And that deferral is at risk. So you need to take advice on this. You need to discuss this with your accountant and be sure and clear about what you're trying to achieve from all this and what you're willing to risk to leave there for the future.
Yeah.
And then the last thing, obviously, you come to the agreement, you get a solicitor to write up a share purchase agreement, and you all sign it, and then hopefully you take some money out.
Yeah, hopefully happily ever after.
Exactly.
That's brilliant. Well, thanks very much for coming on the show anyway. Talk about that. It's been amazing.
Thanks very much.
Thanks everyone for listening. And if you want to know a little bit more about management buyouts from today's episode, please take a look at our free ebook in the comment section below. And if there's any topic you want us to discuss in a future episode, again, please leave a message in the comments below. Thanks again for tuning in, and don't forget to like, share and subscribe.